Something massive is happening behind the scenes, and it's not just a warning shot, it's a full-blown alarm bell. China has just stopped lending money to the United States, falling from the second-largest holder of U.S. debt to third place. That's right. Beijing, once one of America's most reliable creditors, is now dumping U.S. Treasuries at an unprecedented pace. And as America's debt skyrockets over $36 trillion, guess who's stepping into the vacuum? Not Japan. Not the EU. It's the United Kingdom, now the second-largest holder of U.S. debt after a stunning reshuffle in global finance. What's really going on here? Meanwhile, rating giant Moody's has slashed America's once pristine credit rating, citing unsustainable debt, political dysfunction, and interest payments spiraling out of control. And if that wasn't enough, Donald Trump is hammering the Federal Reserve, demanding emergency rate cuts and openly criticizing Jerome Powell. Folks, this isn't just political theater. It's a high-stakes monetary mutiny, and the consequences could be catastrophic. If you think the dollar is untouchable, think again. If China won't fund America anymore, who will? Stick around, because we're diving into the unraveling of U.S. financial dominance. And if you care about your money and your future, subscribe now. You don't want to miss what's coming next. Let's start with the news of the United Kingdom overtaking China to become the second-largest foreign holder of U.S. Treasury bond. While the amount itself may seem small, this is a major shift in the world of global finance and shows how international money movements are changing. What makes it disturbing is because UK did not move to second position because it is stepping up on buying US Treasury bonds. The reason is because China is intentionally dumping US assets. So moving from second position to third is not a mistake. It is a strategy from China. According to alarming new figures released by the US Department of the Treasury, Beijing slashed its U.S. Treasury holdings by a staggering $18.9 billion in March, bringing its stockpile down to $765.4 billion. This marks the end of a brief rebound seen in January and February. And more importantly, it signals something far more unsettling: a long-term strategic decoupling from the U.S. financial system. According to the U.S. Department of the Treasury, the UK now holds $779.3 billion in US government debt, just above China's $765.4 billion. Japan remains in first place with $1.13 trillion. This is the first time in over 20 years that China is not in the top two, showing that China is making changes in how it manages its foreign reserves and how it views US finances. The UK's rise in US debt ownership doesn't necessarily mean that the British government itself is buying more US debt. London is a major global financial center, and many investors from around the world use it to manage their money. Because of this, US debt held by investors in other countries might still be listed under the UK. It is important to note that the UK can't save America, and losing China as a lender is a dangerous mistake. At first glance, this might seem like good news, but look closer and you'll see just how risky this really is. The UK cannot and will not replace China as a reliable lender to the United States. In fact, trusting Britain to fund Washington's massive national debt is like leaning on a collapsing wall. Let's talk about facts. China has been one of the most important buyers of US Treasury bonds for over 20 years. At its peak, China held more than $1.3 trillion in American debt. Even after recent cuts, it still holds over $765 billion. These bonds help the US government fund everything, from military budgets and infrastructure to Social Security and Medicare. Without foreign countries buying US debt, America would need to raise taxes, slash spending, or print money, leading to inflation and instability. But now China is pulling back, cutting nearly $19 billion in US debt in just 1 month. One problem with relying on the UK is, it is also drowning in debt. As of early 2025, Britain owes over £2.8 trillion. That's almost 100% of its entire economy. Worse, its monthly interest payments just hit £4.3 billion, the highest for any March on record. This is not a rich lender with cash to spare. This is a country struggling to pay its own bills. To make matters worse, the UK is facing a shaky recovery. Yes, it grew 0.7% in the first quarter of 2025. But economists warn this may be temporary, driven by companies rushing to invest before possible US tariffs hit. Once that wave passes, the UK could slide back toward stagnation. Unemployment remains high, businesses are angry about rising taxes, and many wealthy individuals are threatening to leave the country altogether. Losing China as a lender is not just an economic problem, it's a national security threat. China has the world's largest foreign exchange reserves, and for years, it kept American interest rates low by buying massive amounts of our debt. If China keeps selling and others like the UK can't step up, the US will face higher borrowing costs, weaker dollar confidence, and a flood of new economic problems. Let's not kid ourselves. The UK cannot replace China. It doesn't have the money, the reserves, or the political stability to take over as America's main creditor. If Washington doesn't fix its relationship with Beijing or find a real backup plan, it may soon find itself out of lenders and out of time. China has reduced its US Treasury holdings, but this doesn't mean China is completely pulling out. Instead, China seems to be shifting from long-term to short-term US debt. This makes it easier to respond to changes in markets and reduces risk if US financial conditions worsen. This move shows that China is worried about how the US is managing its debt and politics. By buying shorter-term bonds, China keeps more flexibility and less exposure to long-term problems. This change isn't random. China is watching America's growing debt problem closely. The US government keeps borrowing more and more money, and the United States is now paying over $1 trillion a year just to cover the interest on its national debt. And that should alarm every American. This staggering figure doesn't go toward building roads, funding schools, or supporting healthcare. It's simply the price of borrowing money. Interest payments have surged because the national debt has ballooned past $36 trillion, while interest rates have risen sharply in recent years to combat inflation. In simple terms, America is using your tax dollars just to pay the minimum balance on its credit card bill. According to the Congressional Budget Office, interest costs are now the fastest growing part of the federal budget, so much that the Senate may have to add $1.1 trillion to the budget just to service the national debt. And within just a few years, these payments could outpace defense spending. That means less money for core programs and more economic instability. What's worse, much of this debt is owned by foreign nations. If they lose confidence in US finances and stop lending, interest rates will soar even higher. That could cause a financial crisis. The US is essentially trapped in a debt spiral, and unless serious reforms are made, the situation could spiral out of control. But China's concerns go beyond just the debt numbers. Politics in the United States have become messy and unstable. With leadership changes, partisan gridlock, and constant shifts in trade policy, especially under the Trump administration, China finds it harder to predict what America will do next. One month, the US slaps new tariffs on Chinese products. The next month, those tariffs are rolled back or replaced. That kind of unpredictability doesn't inspire confidence. China needs stability to invest large sums safely, and lately, Washington hasn't provided that. Trade tensions are another reason China is getting cautious. For years, the US and China have been locked in an economic tug-of-war. Tariffs go up, retaliatory tariffs come back, and the relationship swings between negotiations and threats. These trade fights hurt trust. From China's point of view, it makes little sense to keep lending billions to a country that might turn around and sanction it tomorrow. At the same time, China is also rethinking how it manages its vast reserves of money. Instead of putting all its eggs in the US basket, it's diversifying, buying more gold and investing in other countries. The goal is to reduce reliance on the US dollar and protect itself if the American economy takes a turn for the worse. This is a big deal, because China has long been one of the most loyal buyers of US debt. A move away from Treasuries doesn't just hurt confidence, it could raise borrowing costs for the US government, putting more pressure on the already stretched budget. On May 16th, Moody's Investors Service downgraded the U.S. credit rating from the highest AAA to AA1. This follows earlier downgrades from Fitch in 2023 and S&P in 2011. Moody's said the U.S. is taking on too much debt and not doing enough to control its spending. Interest payments on this debt are rising fast and could take up a large part of government income in the future. This downgrade is a clear warning that investors are losing some trust in how the U.S. handles its finances. After the downgrade, investors are paying more attention to U.S. financial decisions. Even though markets didn't panic right away, the long-term effect could be higher borrowing costs for the U.S. government if fewer foreign investors want to buy its debt. Central banks and other major global investors may begin to lower their U.S. debt exposure or look for alternatives. If this trend continues, it could shake up how money moves around the world and hurt the U.S.'s reputation as a safe place to invest. Adding to the turmoil, President Trump launched a scathing critique of Federal Reserve Chair Jerome Powell, demanding immediate interest rate cuts. In a social media post, Trump labeled Powell as "too late Powell," accusing him of consistently failing to act promptly and warning that he might blow it again. This public rebuke of the Fed's independence not only undermines investor confidence, but also worsens fears of political interference in monetary policy. The president's call for rate cuts comes amid a backdrop of economic uncertainty and market volatility. The Moody's downgrade has already begun to impact investor sentiment, with expectations of increased borrowing costs and heightened scrutiny of U.S. fiscal policies. The administration's push for further tax cuts, encapsulated in the proposed One Big Beautiful Bill Act, which aims to implement approximately $3.8 trillion in tax reductions over the next decade, has drawn criticism for potentially exacerbating the deficit by over $2.5 trillion. History offers a grim warning. In the 1970s, under political pressure from President Nixon, Fed Chair Arthur Burns kept interest rates artificially low to grease the wheels of re-election. The result was a lost decade of stagflation, collapsing purchasing power, and soaring unemployment. Today's echoes are chilling. Hand-picked Fed governors whispering dovish forecasts, market bets on premature rate cuts, and rising fears of inflation becoming embedded once again. But this time, the stakes are global. If the world believes the Fed is no longer independent, the dollar, the backbone of the global economy, will begin to rot from within. And while America quarrels with itself over monetary policy, the rest of the world is quietly building digital escape hatches. Nations bruised by U.S. sanctions, swift lockouts, and dollar dependency are no longer begging to be let back in. They're building parallel systems designed to keep the U.S. out. China's digital yuan is already operational across parts of Africa and ASEAN, offering programmable money and trade settlement free of U.S. oversight. Iran and Russia are experimenting with blockchain-based payment corridors that bypass legacy American infrastructure entirely. Bloomberg terminals, dollar-clearing banks, and Moody's ratings still dominate today. But for how long? What happens when financial trust becomes programmable, borderless, and immune to Treasury Department dictates? The West's weaponized financial system, once a deterrent, is now accelerating the global fragmentation of money itself. The next sovereign debt crisis may not be resolved at the IMF, but across decentralized ledgers the U.S. doesn't even control. Here lies the true alarm. As the Fed loses its grip to politics, and the dollar's architecture is silently duplicated elsewhere, America risks waking up to a financial world where its influence is no longer required, nor welcome. And the worst part? The code is already written. So if you care about your future and your finances, hit subscribe and turn on the notification bell, because what's coming next makes this look like just the warm-up.